And we're back on halftime. Dom Chu is standing by with today's ETF Edge.
All right, so Frank, as third quarter earnings and economic data increasingly paint a picture of a fragmenting type market, where are investors themselves seeing the best opportunities in terms of where they're directing their money? Joining me now is Paglia, the Chief Business Officer and Global Head of ETFs at State Street Global Advisors. They know a thing or two, I would say, Anna, about ETFs. You guys are one of the biggest issuers out there. Where exactly are investors right now gravitating towards in terms of not just maybe stocks, bonds, ETFs that cover commodities, but what parts of the market are they most hot on right now?
Well, the market overall is really hot right now. ETFs are having a record year. We had $1 trillion of new assets, new money into the ETF industry year to date, which really breaks a new record for the industry. So what we see, a lot of focus in a low cost. Low cost continue to dominate. Almost 0.5% of the new flows go into low cost beta exposure.
Now, what type of, when you say low cost relative to other ETF issuers out there, and exactly where are they going in terms of the types of investments in ETFs that are the low-cost ones that you're speaking about?
That's right. So we see a lot of flows going into the S&P 500 exposure, so SPY, SPY-M, the mini SPY, but we also see sectors having a rebound after Liberation Day.
What types of sectors are getting the most attention right now?
The most attention right now, I would say, is financials and industrials. They have seen a lot of new assets coming into the market. In the month of October, we have seen $5 billion into that combination of financials and industrials.
And Anna, you made quite a few waves with the recent op-ed that you penned out there with regard to how retirement accounts, like in 401ks, are doing vis-a-vis the ETF versus mutual fund story. State Street, known for ETFs, is getting a little bit more into the mutual fund side of things. What's the quick reason for why?
Well, the quick reason is to put the same exposure under one umbrella. Right now, exposure to the S&P 500, for example, is very fragmented. Retirement industry is $4 trillion strong when it comes to index, but that exposure is fragmented across mutual funds, CITs, SMAs, target date funds. Our vision is really to bring everything under one umbrella. That will reduce costs, avoid fragmentation, and give the same exposure.
Interesting point here, Frank. We're going to have a lot more to discuss on this. We're going to continue the conversation over at etfedge.cnbc.com. Anna is going to be joined by Todd Rosenbluth over at Vetify, the director of research there. But interesting that an ETF provider, Frank, wants to get more into mutual funds these days. I'll send things back over to you.
Our Dom Chu with today's ETF Edge. Dom, thank you very much.